Good morning and welcome and happy 2019. So you have also tried to make a new beginning, right? Again going back to school. So what we are going to learn today or in this particular course is purely basics of accounting. And when I talk about basics of accounting, normally what happens is you will say, oh, there is a debit, there is a credit, etc. That is the first term that basically would come into your mind. And let me make that clear that I am not going to look at it from the debit credit point of view at all, because moment I bring in a debit credit point of view, then I would be losing at least about 60% of the class right first day. So I am not even getting into that. My objective here would basically be for you to appreciate if somebody gives you the financial statement, for you to understand the interactions between the financial statements. That is all. Look at it as a manager, not look at it like the person who is going to basically prepare these financial statements. That, let me make that very, very clear. The objective is not to make you prepare the financial statement. So it is slightly different from the way we typical accountants learn, that we quote unquote an accountant and a manager. There is a lot of difference. We are going to look at it from the managerial perspective, that is all, not from the accountant perspective, not to prepare a financial statement, not to tally the balance sheet. Finally, I might expect that in the examination, that is a different issue, but not typically to prepare a financial statement per se. So let us get that aspect very, very clear. Simple aspect what you say, why I said I am not going to look at debit credit part of it is, moment we say what is debit is good or credit is good? Debit is good. What happens to your salary? So credit is good or debit is good then? Credit is good, right? But whereas if you look at typical accountant, they will say debit what comes in. That is, if some money is coming in, if asset is coming into you, they will say debit it. And whereas you will say immediately say, okay, my salary is coming to my account, why is it credited, why is it not debited, right? The confusion starts there and then it is never ending. So let us ignore that for the time being. Let us ignore that for the time being. Let us come back with basic accounting. When we talk about accounting itself, we look at only financial statements. I will start from financial statement. You would have certainly heard about balance sheet, you would have heard about P&L statement, and the third statement what I am very sure you might have heard about is what we call it as a cash flow statement, that we will talk about. Now what is the profit and loss statement, what is the cash flow statement? Let us first, do you need, does profit not indicate the cash what I have? Yes or no? Based on accrual accounting system, fine. Now I have to explain that accrual for the rest of the audience, rest of the students here. Now when we talk about a profit or loss statement, or we normally say profit or loss statement, income statement, or revenue and expenditure statement. Depending on the concern, the terminology will change. Profit and loss is basically for a profit making enterprise, whereas when you talk about a revenue and expenditure statement, it is more suited for what do you call it is a non-profit enterprises, etc. There it is revenue, no profit. So what we call it, they call the profit as excess of revenue or expenditure. So let us not even get into that. So when we talk about, so all these three basically mean, it means what you call it as you are looking at locking in the revenues out there or clocking in the revenues out there, that is whatever you are earning, and you are clocking in whatever you are spending. The first and foremost concept out there when we talk about accounting itself is, as he said, accrual concept. What is this accrual? God damn it, what is this accrual concept? Normally how do you keep your monthly accounts? You keep your monthly accounts depending on how much money goes out of your wallet or how much of swiping of the credit card you do. You basically take it as what you call it as an expenditure, and your salary is only source of income, you take it as your income. When we talk about accounting, we talk about accounting from the accrual in the sense we will take it as an expenditure irrespective of whether it is paid or not. Once the ownership is transferred, we will take it as an expenditure. For example, let me take, normally accounting year is what, April to March, all of us know that. Supposing on 31st of March I make a sale, my organization makes a sale for about 5 lakhs, and the goods get, and I make a sale of 5 lakhs and I sell it on a 90-day credit. That means April, May, June, June 2nd is when I am going to get the money on the sale that I made on March 31st. Money has not come in. As of today, the sale has taken place, the invoice is prepared, or whatever it is, the goods are moved out of the factory. Now, for the financial year, let us say 2017-18, let us say 2017-18, 31st of March 2018 is when the sale has taken place. Do you consider it as a sale for the year 2017-18, or you will get the money only in June, so you will consider it for a sale in the year 18-19, that is the next year. As far as accounting goes, we follow accrual, that is the ownership has transferred, the goods have left your factory, that is it is sale has accrued, irrespective of whether you receive the money or not, that is secondary. Sir, what happens if they do not pay? There is a legal course, you take it, but the sale is over, the sale has taken place. When that fellow does not pay, you book it as a loss in that particular year of 18-19, that is the next year. But as of 17-18, what has happened? The sale has taken place, the ownership has basically transferred. That is what we call it as accrual concept. That is, the sale has basically accrued, the event has accrued, the ownership is transferred, then we call it as accrued. So, when we talk about P&L revenue, what happens in this particular case? That 5 lakhs is a revenue because it is sale which has taken place. So, you will write it as a revenue for the year 17-18. Let me again clarify. 17-18, March 31st 18, sale taking place for 5 lakhs, 90-day credit. So, first thing what we understood, we said that we will record it as a sale in the year 17-18. So, we are not even worried about the getting the money, that is irrespective of it, that is, let us keep that aside. So, as of now we have recorded it as a sale. Once we record it as a sale, then what happens? That increases your revenue, am I right? That increases your income. So, naturally all the expenditures you knock off, then you get some amount of profit you get. That profit figure will have that 5 lakhs which is added in your revenue also. So, will profit be equal to the cash what you have? No, profit will not be equal to the cash because you are yet to receive. So, that is what we call it as accrual. That is one of the reasons we look at a different financial statement, that is what we call it as the cash flow statement. A profit and loss statement, again I repeat, is purely on what we call it as accrual basis out there. Accrual, that is, whereas when you look at a P&L statement, the second aspect of a P&L statement, we talk about a P&L statement popularly called as P&L is always for a specified period, time period. It can be a day, it can be a month, it can be a week, it can be a year, etc. It is always prepared for a specified period, what is the revenue and what is the expenditure, and what is the income and what is the expenditure you are basically looking at. We call it as P&L account, normally profit or loss account, or the other way to look at is revenue and expenditure account. I am sorry, my writing will be slightly, you will have to, you can figure it out because I keep repeating also. Now, when we talk about in this particular case, when we talk about what we call it as the P&L account and revenue account, normally what happens is this is for a what is called as we follow accrual concept. Accrual concept is we record what has basically accrued in the sense what has the event has taken place. We always look at it as an event has taken place. Simple example, sir, one more example I will give. Imagine a typical factory, manufacturing, small scale or a medium scale factory which works in, they pay, I mean as per the government regulation one can pay the salary up to the 7th of the subsequent month. Now, as of 31st of March, I prepare my financial statement. The worker has basically performed his duty or his activity for the month of March. Now, when I prepare my financial statement on the 31st of March, I am liable, I use the word, I am liable to pay salary to my employee, though actually cash would not have gone out of my account out there, because he has performed the activity, so I am liable to pay. So that was that amount what I have to pay, which is accrued, that means that job was performed by the worker or the employee during the month of March. So the amount is liable for the month of March alone. So that I will take it as what is called as an expenditure for the month of March 17-18 in this case, not when I actually pay in the subsequent year out there. So I will show it as an expenditure, because the expenditure has accrued, the worker has performed his activity. So what happens is the event has taken place. If the event taken place, event can be transfer of ownership in the case of sale and purchase. Once the event takes place, once the ownership gets transferred, then it is considered as a transaction, and whatever is the resulting, whatever, whether it is an income or an expenditure, gets obviously recorded in your books of accounts. Understand the basic concept of P&L? So what we say when we talk about a P&L for a specified time period, I said specified time period, that is April 1st of 2017 to March 31st of 2018, it is for that specified period. In that specified period, any event that has occurred and any transaction or any financial commitment that is accruing will get recorded, pertaining only to that particular period, pertaining only to that period. Let me take one more example. Today it is going to be more of, I am going to be lecturing more because I am getting the basics. Tomorrow I will use an Excel, we will get you some numeric, also make you feel more comfortable, right, that is the idea. Let us take let me take an example. Supposing on 1st of March you are a manufacturing concern, on 1st of March you make a purchase of, let us say, 50 lakhs worth of raw material. Now suppose I said 1st of March 2018, 1st of March I make a purchase for about 50 lakhs of raw material, and I have bought this raw material on a 60-day credit, note down. That means that I am liable to pay not on April 1st, on the 1st of May, supposing 1st or 2nd of May, that is what it is. Now as far as my statement is concerned, the goods has come in, basically the ownership has transferred to me, so it is a purchase that has been made actually. I utilize all the material to manufacture some particular good out there, and then I sell all my goods that I have manufactured on the 25th of March 2018 on a 90-day credit. That means payment happens in June, sometime May 25th or so. Then what happens? I will record purchases rupees, that is goods or material utilized in this particular year to the tune of 50 lakhs. And imagine I have manufactured something and sold it for about 75 lakhs. I will say my revenue is 75 lakhs. My net profit, imagine there is no workforce, it is only packing and repacking which I do, and which costs another, say, let us say 50,000 or something. So what happens? My profit is 24.5 lakhs will be my profit what I have earned for the year 17-18 only from that activity. If you look at your cash box, it will be 0, but payment happens in the next subsequent year. He says taxes. Now what happens? On that 24, on that whatever money out there, there is a tax which has accrued, because on the profit you are liable to pay taxes. And as per income tax regulation, you will have to finish the tax payment before 15th of March, etc. If you have anticipated what is the profit, you do it. If you have not anticipated, it's a windfall gain is what is the profit. You are arrived at a profit on 31st, and then you have to calculate what is the tax plus what is the fine on the tax because of the delayed payment, and then the remaining amount will be the profit. And you will have to immediately ensure that the money gets transferred. You can say there is no money in my cash box, go borrow, loan, and then pay the taxes, that is obligatory. So that part we will keep that aside as of now. Yes sir, you have agreed for a sale or you have sold, there is a difference. agreement for sale is different from the sale. If the sale has taken place on the 1st of March, ownership has transferred, I record it as a sale. On 1st of April, he cancels the order, that is returns all the goods what I have sold it to him. I will treat it as a return that has occurred in the subsequent year 1819, not in 1718, that 1718 is closed, right. If it is an agreement of sale, then my books of accounts will have no entry. There is nothing, no entry in my books of accounts at all, because it is only an agreement, ownership has not transferred, event has not taken place. There is no obligation for him to pay. For example, let us take another example, sir. I hire 5 people for my managerial cadre by paying a salary of about 2 lakhs per month for each of them. What I have done? I have issued an appointment order for 5 of them. When does it I become liable to pay? I become liable to pay only after they have joined my organization and even performed a job for 1 hour. That is when I am prepared, I am supposed to pay 1 hour of wages out there. Till that time, there is no transaction that has basically happened. It is only what is called as an agreement, and accounting statements are not bothered about that. When I give a credit, my sale price includes my cost of funds. I said 90-day credit, I sell it on 31st of March. Supposing I say, he comes in and says, I will pay you right cash immediately. Then what do? You give in a discount of 10% or 5% or whatever is your cost of fund, you give in a discount. That particular cost of money or working capital cost or whatever we call it, that is already built in your selling price itself. And any discounts given on that because of an early payment, etc., what we call it as cash payments, no, cash discounts, I am sorry, cash discount normally. Am I with you? Taxation is purely based only on your profit, P&L account, that is all. What is profit has accrued, profit or loss has accrued. Forget about cash flow. Cash flow, let us not even worry about cash flow in today's class. We will worry about cash flow later. Am I clear? Any other questions at this stage? No, we will revisit P&L tomorrow also, no problem. Next 2 classes we will be only visiting P&L and balance sheet. Yes, please. Sure, sir. Any number of questions. No, don't have to restrict your questions. We have, today is the first day. It's only half an hour. Still, we are going to keep meeting for the next 3 more months. Yeah.
You spoke about the cash discount, right?
Yeah.
Would that also be part of the MRP of the sold price, or will you show it on P&L, or would you only?
It will be basically, supposing I sell it to you for 50 lakhs, whatever I said, 75 lakhs, what I said now, on 25th of March. The next aspect what we talk about in this particular case, what we see is basically what we call it as the balance sheet. How different is balance sheet from your P&L? Or is it the same? Assets and liabilities, everybody said assets and liabilities, fine. Investments, what you bring into the business, you are also right, sir. Which the company owes. See, asset is nothing, what we call it as whatever the entity owns. Liability, normally whatever the entity owes out there, that is all. Now, when you talk about, they always say capital plus liability. Am I with you on this? They will always say capital plus all the liability, equity plus liability. This is the word that normally they will use, equity plus liability. Why is equity plus liability? Why is equity joined with your liability? See, first and foremost, we always follow what is called as, we talked about accrual concept. The second concept what we look at is an entity concept. An entity concept. Entity concept is, even if you start your own business, for example, I am Arun Kumar, I start a sole proprietorship out there, that is I start a company out there, I file my tax return independently, my organization, that is Arun Kumar and Co, or whatever it is I start, that will file that tax return independently. That is, it is a separate entity. Now what happens? I as Arun Kumar, I have contributed 10 lakhs to my business as what you call it as equity or capital or whatever you might call it by other various names. Now, at the time of dissolution, the time that Arun Kumar and Co decides to wind up, Arun Kumar and Co owes the 10 lakhs back to me out there. I am separate, that organization or the whatever entity, the business house what I create is independent out there. So, whatever the entity owes, that is where we will always say equity plus liability. Tomorrow you will say Sir, I have invested in Reliance. Do you think Reliance is going to pay me the money back? Yes, if at all they wind up, the day they wind up, and if at all you are alive till that date, right, which might be you do not know how many centuries later also, none of us know about it, right. So, yes, they are liable to pay you back if at all they have some money left after clearing off other liabilities, if at all they have some money left after clearing off all the liabilities out there. So, let us not worry about that too much. So, when we say asset, that is all that you own. When you say liability or equity, all that the organization or the entity owes out there. So, first and foremost, entity concept, you are a separate entity. The organization or the business that you are basically creating is an independent entity or an enterprise out there. So, the books of accounts of that is different from the books of accounts of what you maintain for yourself out there. Now, when we talk about capital, we talk about equity, we talk about liability, etc. Now, when we say balance sheet, can asset position change every day? Yes. Why? Depreciation. Okay, fine. Even simpler. Market value. No, market value. Let's worry about it. Agreed. You are right. You are not wrong. I am talking about even simpler. Every purchase on credit, agreed, okay. Simple. What is cash that you have in your pocket? Cash is an asset. It will change every minute. That's all. So, cash is, supposing I say now, what happens? Cash is an asset. So, all that you guys said are correct. I am not saying it is wrong. But why complicate life when life is so simple, right? Cash itself keeps changing. Every minute your cash changes, cash in your cash box changes, every minute the money in your account changes for a business house, because there is a continuous debit or credit that keeps happening all the time, or sorry, there is a continuous addition or reduction of money that keeps happening, not debit and credit out of it. So, when we say, suppose let us take one example out here, you borrow some 100 lakhs, or what I call it as 100 lakhs is how much. Okay, that is say 100 lakhs out there from a bank to purchase a furniture, whatever it is, to purchase your building, an office building and furniture office building. Now, what happens?
It becomes an asset.
What becomes an asset?
That what you have borrowed.
What I bought becomes an asset then? What is a liability? Liability for an asset. See, no this. Okay, forget about buying an asset. Let's say you go to the bank, that guy is giving you take a loan of 50 lakhs and that guy has given you piles of cash of 50 lakhs out there and you have just taken it out. Now, what is it? What is the cash with you? Now, what is it? Is it a liability? Is it an asset? Liability. The cash you have taken 50 lakh bundles are in your hand, and that minute you get robbed. What happens? Who owes the money? You owe the money or the bank owes the money? So, who owns the money? Who owns that 50 lakhs? Moment I just take it out of the counter, who owns that 50 lakhs? So, what is it for you? That's all. The liability is parallelly there. Yes, liability is there. You got to pay. That's a different aspect. But moment you put your hand on the cash is yours. That is, you own the cash. Please understand that. There is a liability, parallel liability. Bank you have to pay. That's okay. But the cash is yours. So, what happens when you borrow money? There is a liability which is going up, that is to the tune of 50 lakhs out there. There is an asset also consequently going up, that is that cash comes and sits in your cash box out there, that is your cash balance also goes up by 50 lakhs. So, your liability has gone up by 50 lakhs, your asset has also gone up by 50 lakhs. Am I with you on this? It is also a liability for you, agreed. Cash is an asset, what you owe is a liability. Please note, there are two different things. Cash is an asset, what you owe is a liability, right? You buy a car, take a loan and buy a car, fancy car for 15 lakhs or 20 lakhs out there. Car is your own because it is registered on whose name? Your name, hypothecated to the bank, that is independent. It is on you. Car is owned by me, but I need to pay money on that car, that is a liability. So, there is always what is called as a liability that also accrues. There is an asset which also basically gets created out of the money out there. Now,
does every asset comes with a liability?
Every asset comes with a liability, we will come to that in a minute, sir. Now, what happens when we talk about what we call it as, yeah, got it. What happens when we talk about in a balance sheet out there, we said what is called as a equity, or what we call it as capital plus liability. Equity slash, what we talk about this side is all your assets. What I talk about the other part of it is all your assets out there. Equity is part of capital, let me make that very clear, because equity is a commonly used terminology, that is why I specifically mentioned out there. Equity is part of your capital plus all your liability out there. Now, what happens? Initially, imagine I incorporate a business, I put in 10 lakhs as capital equity in my business. First aspect, what happens? There is a capital which is there on the liability side, a liability plus equity side of the balance sheet. There is a cash which is sitting on the asset side of the balance sheet. Agreed, your balance sheet, that is there is what is called as money coming in, there is an asset out there. I use this 10 lakhs to buy what is called as a small office space out there, then what happens? It is not remaining as a cash now, it becomes what is called as a building which I own, and the value of the building is 10 lakhs out there, straight. So, then second aspect, I borrow 50 lakhs from a bank, and then immediately what happens? Your asset will be basically 10 lakhs building, 50 lakhs cash out there, imagine you have taken cash. Your liabilities is capital 10 lakhs plus borrowing 50 lakhs out there. Third aspect, I use this 50 lakhs to buy whatever my factory etc out there, then this 50 lakhs, 40 lakhs out of that I use to buy my factory etc. Then what happens? Initially 10 lakhs is basically what you call it as the building or the factory premises, 40 lakhs is your equipment, 10 lakhs is the cash remaining. So, 40, 50 plus 10, 60 lakhs is your total of your assets. On the liability part of it, equity is 10 lakhs, bank borrowing is 50 lakhs over. Next, I buy raw material on credit for the tune of 10 lakhs. I buy raw material for 10 lakhs to the tune of on credit to the tune of 10 lakhs. Now, what happens? There is material coming into your what is called as godown. Now, what happens to your asset part of it? Your asset part of it is already about what is called as 10 lakhs as building, 40 lakhs as machinery, 10 lakhs as cash that is there, another 10 lakhs gets added as their raw material which is there, that is stock of raw material that is there. On the liability part of it, what happens? Equity is 10 lakhs, bank borrowing is 50 lakhs, then creditors, creditors means to whom you ought to pay the money is another 10 lakhs out there, that is also 60 lakhs out there. So, what are you seeing? That liability and equity part of it, what we call it typically is basically all this entire thing, what I call it is basically the source of fund. And what I have in my, when I talk about my asset part of it out there, out here in this particular case, this is basically uses of my fund, that is what we call it as utilization of my fund. So, my sources will always be equal to my utilization. If I make an inefficient utilization of the source, then what happens, sir? There is a loss, that is all. If I make an inefficient utilization of the source of fund, then there is a loss out there. Very simple, sir. Imagine I start a company, I decide I am going to manufacture, I want to quit this job and manufacture some toys out there. Let me say I contribute, I borrow from him 10,000, I put in 10,000 as my own money. So, what is happening? Day 1, capital equity is 10,000, borrowing is 10,000, my cash is 20,000 out there. Agreed? Day 2, I use this 20,000 to buy raw material. Now, what does my balance sheet look like? 20,000 on the liability side, that is capital equity plus liability, 20,000 on my asset side, that is what happens is I have bought the raw material for it. I manufacture some toys out there. Once I manufacture a toy, he decides to buy the toy from me because it looks so fancy and beautiful. He decides to buy it from me for 24,000 and he says 1 month credit. Then what happens? The toy which is there with the value of 20,000 in my books gets out of my books to him, and debtors out there, DEBTORS, debtors are receivables from him becomes what is called as sale as second place in the balance sheet. So, receivables from him becomes 24,000. So, what happens? My balance sheet will look like, my balance sheet will basically look like what is called as my equity 10K, my borrowing 10K, and I have made a sale, my receivable 24,000 because I have sold it to him for 24,000. I am liable to get, I am eligible to get what is called as 24,000 from him. So, what have I done? I have made a efficient utilization of the source of fund, that is whatever the source I had, I have made a efficient utilization, I have enhanced the value of that money. Moment I have enhanced the value of that money, there is a 4,000 that is profit which is created. This 4,000 belongs to whom? Belongs to the capital provider or the equity provider in this particular case. Supposing I say the same toy, what I have created, it does not turn out to be a toy, it just becomes a monkey, and then he says I do not want to buy it because there are too many of them on the campus in IIT, so I will buy it only for 15,000 from you. Then what happens in this particular case, what I am eligible to get from him is only 15K. Then what I have made? I have made an inefficient utilization of my fund out there. When I made an inefficient utilization of the fund, who bears the loss? The capital provider bears the loss, that is he does not bear, I have to bear the loss. He is just I have borrowed money from him, I have to basically bear the loss as an equity provider. So, does every asset is it backed by a liability? Well, yes and no. Normally yes, if you make an efficient use, you may not have a direct liability which is there, which is equity or liability which is there, but it will get whatever is the resultant difference out there, that is a value that you have created, and that also becomes a liability, that also becomes what is called as you have to flow it back to the equity or the capital providers of the firm out there. Am I with you, sir? Question: if you have paid, what happens as of today? Let us look at it. Let me say that, oh sorry, yeah, you had a 24K, you have sold it. Now what happens? 4K becomes what is called as the profit which is to be paid to the equity provider. The minute I pay, then what is the cash? It's supposing this receivable, that is when will you pay? When this receivable becomes cash, only then you will pay, that is once I have received the money is when you pay, because without receiving the money you can't pay, right? Only when the receivables, you have received the money, you pay. Once you pay, how much of cash you have? 20K. So what happens? This becomes 20K. Once you pay, are you still liable to pay him? No, that is also gone. So still your balance sheet is, that's all. Where is the cash in hand is only 20K, 20,000 out there is what you will have as cash, and your capital is equity the same thing and borrowing the same, 10 lakhs out here, 10 lakhs out here, 20 lakhs out there, that is what will remain out there. Equity will, you see what is equity? Moment the profit is made, then what is the value of the equity? Value of the equity is 10 plus 4, 14, because the profit belongs to whom? Belongs to the equity provider. So equity becomes 14. Moment I pay 4, equity becomes 10. That's all. Instead of paying 4, supposing I have borrowed, it's my company, I manage it. Now instead of taking 4K, I take 6K out of the business. Then what happens? My capital becomes 8K in the process. My cash is what is called as 18K in the process out there. Equity holder, because when the entity, what happens is when we talk about an enterprise, any profit or loss is borne by the capital providers of the firm. And when I say capital providers, it is not the debt provider, because when we say capital, capital is a big term, equity plus debt, we take it is more and more the equity providers of the firm out there. With you on this? Loss is also shared only by the equity provider.
But when you said receivable is 15K.
Yes, I will take this, I will again do that as an example, don't worry, 1 second, sir. Now what did we say? Equity was 10K agreed, my borrowing was another 10K. Now, I would be said what is called as the cash what I have, that is after selling you have sold it at a loss, what you have is basically 15K. Now, there is a loss of 5K. Who bears the loss? The loss basically, because imagine after selling the toy, if I wind up that business and imagine he has given on a friendly loan, no interest, I need to pay him 10 lakhs out there. When I pay him 10 lakhs, this borrowing goes out. Agreed? So, what is the money? So, what happens? This cash becomes what is called as 5K out there. What is the cash with me? 5K. Who bears the loss? Loss is basically borne by this fellow out there, that is the equity provider. So, equity provider now gets only 5K, not 10K in the process. He is an investor, that is all. He is an equity provider. Equity provider takes all the risks out there, that is whether it is in the form of profit, yes he gains, in the form of loss he has to bear it.